Morning, everyone. Welcome back to class. I want first start off today by quickly reviewing the guidelines that I posted for your case study. Because the weekend is coming up, and I know some of you may want to work on it over the weekend. Everyone can see it? It's large enough? Okay, I hope some of you at least have taken a few minutes to skim through your case. If you haven't, you should set aside the time to do a first reading sometime today or tomorrow over the weekend. Now the thing with the case, the reason I give it to you so much in advance is because it's not the kind of question that you can sit down and begin to know how to answer immediately as soon as you read it for the first time, because there is a lot of information on there. It's not organized in any particular manner. It's just a bunch of information, a narrative about what happened, about the history of the company for the last 2 or 3 years, and it's very unstructured. There aren't any questions at the end of the case, if you've noticed, right? But really, like I said last class, the implicit question in any case is always figure out a way to solve the problematic situation at hand. Okay, so that involves 2 components: diagnosing the problem and then coming up with a series of recommendations. The key thing that many of you will need to practice, which I'm hoping you'll practice through this case, is when you come up with a solution to a problem, to a recommendation, or with a recommendation, sort of possible solutions that the managers can pick from. It's important to support your recommendations with something more than just your intuition. I feel like the plant should be closed down, or I suggest the plant should be continued because it's losing money, or one as opposed to the other. It's important to support your arguments with something more than just your intuition and stating the obvious. Okay? Because what I want you to do is I want you to put yourselves into the shoes of a team of consultants, okay, who have been called into the Insteel facility to assess the situation and offer solutions. So you're going to be paid a lot of money. Imagine you're being paid a lot of money, okay, to come up with your suggestions, with your recommendations, and other people are going to be betting a lot of money, are going to be investing a lot of money into whatever solutions you come up with. So in practice, when you're doing this, if any of you gets into management consulting or strategy consulting, it's important to have an arsenal of hard facts and hard numbers always to back up whatever solution you propose. Okay? So I want you guys to keep that at the back of your mind. Does anyone have a copy of the case that I could? Thanks. You can share that. So the case is about 4 pages of narrative. Okay, the first couple of pages gives you a historical background into Insteel. Okay, and an activity-based costing system that was implemented in Insteel. Insteel didn't already have an activity system; they put one in after a team of management consultants recommended they put in an activity-based costing system a few years ago. And then they put in the ABC system, they ran it for a couple of years, they did a bunch of things based on the findings that came out of the ABC study, and then you're given a follow-up 2 years after the introduction of ABC, what happened. So you have information about Insteel at 2 different points in time. First, at the point in time just before they put in the ABC system, and then they made a bunch of changes based on the ABC study, and then 2 years later, you know also what happened. So you have 2 points in time that you're given data for. You have a bunch of drawings here. This just illustrates to you the production process, the whole chain, okay, the way in which the product gets made. There are some whale, these are called whale charts, okay, presumably because they look like whales. I've never been able to figure out what to do with these whale charts, but if anyone is able to come up with a useful interpretation of the data in the whale charts, I'll be delighted to hear it. And then this is the most important segment of the case, the data, the tables of data that you are given at the end. Okay? It gives you, this is basically information about costs. Okay? There's a listing of costs. There's a hierarchy. Some costs are unit level, some costs are batch level, so you can sort costs into the different buckets in the hierarchy if you find that useful to you. There are a bunch of other information, mostly cost items, cost drivers, and so on. So basically what you're being asked to do here, even though it doesn't actually say so, is to do the activity-based costing and cost all of the product using ABC costing. You're given data for 2 different points in time, so you will be able to calculate 2 sets of costs, okay? One for 95, 96, and another for 96, 97. So that's sort of the basic thing that you should start out trying to do. And then you have to read the case 3 or 4 times and discuss and brainstorm with each other in order to figure out the different angles. So here's what I put together to help you. So for some of you, it will be intuitive. As soon as you read the case, you'll understand what it is that you're required to do, and you will feel comfortable just writing an essay, writing a few paragraphs that diagnose the problem and describe your solution. So if you are comfortable doing that, you should go ahead and do that. Now, others will find it a little bit harder to get started, to get their thinking flowing, particularly to get started structuring a report. Okay? So to help you out in doing that, I came up with a list of questions. Okay? Prepare an ABC analysis for instance. Using this analysis, along with all of the other information, prepare a short report addressed to the management, advising them on how to improve profitability in the future. That's always the ultimate goal, always, right, in specific. And here are the issues that your report should cover, but they don't have to be limited to those issues. Okay? Ideally, a case study is meant to help you break out of this very strict question-answer mode that you're in when you answer textbook questions. Okay? So try to go a little bit above. Use these questions as a guide to help you get your thinking started, and also maybe to help you structure your answer. But don't tie yourself into a very strict question-answer format. Okay, because the case is meant to help you break out of thinking that way. Okay. So these questions will make sense once you've gone through the case and you figured out all the different issues in the case. And there's a typo here. I'm going to change this. It's on Tuesday, November 22nd. I'm going to update this. Okay. A couple of points about your report. There is a page limit, so make sure you adhere to that. Okay. I don't want it to be longer than what's up there. So I wanted to write a report with some text. Okay, a couple of pages, and then any supporting calculations, numbers, charts, graphs that you want to display to support your arguments, I want you to put into appendices at the end of your report. Your appendices can be another 2 sides or whatever it is. So you know how long your report must be at most. You are highly advised to type. Okay, I know I don't insist that you type for the homework, but this is a case study and you're asked to prepare a report to management. So I want you to pretend that that you are really in this position. So I want you to get some practice in preparing a professional looking report, and that obviously means not handwritten. Okay? So type, organize your calculations neatly, right? Do a little bit of formatting, make everything look nice, make it fit into one page. Get used to doing all of that. Yeah, and then work in groups. And then a word of caution to some of you. A lot of the time I get a lot of rehashing and re-summarizing of just the stuff that's already written down for you in the case. Okay? Don't spend your time doing that. because what I'm looking for is for your original thoughts about the case. Okay? So don't feel compelled to do a lot of rehashing just in order to get to that page limit. The page limit is a recommended maximum. It doesn't mean that you have to fill up the page until you get to that point. Okay? If you have, if your thought process makes sense and you've touched on all the major angles, it doesn't matter. Your answer can be 5 lines long and you can still get 10 points out of 10. Okay? Any questions? I think that's on the lesson plan, so you'll have to look it up for yourself. Okay? Yes. Okay, I'm not going to police that, but the larger your group gets, the more group issues you tend to have, so you want to be aware of that. Okay, so let's get back to the web company case that we were working on just before we started, just before your exam, and we picked up again last class. If you could turn to your web company notes. So last class we covered a lot of ground. Okay, we started out by rehashing the web company case. Now this is a case that focuses on showing you exactly how to use budgets for control. Okay? Someone describe to us what we mean when we use the term control. What is the sense in which we use the word control in accounting? What does it mean to use budgets for control? Yes. That's part of it. The setting of the benchmarks actually is what you do when you plan. Okay? And then when you get out of the planning phase and you move into the control phase of your activity, what you're doing then is you're trying to figure out if your plan is working. And not only trying to, actually that's incomplete, trying to figure out if your benchmark, if your plan is working, and if it's not, trying to take some corrective action to make sure that it will work, that you would have achieved your benchmarks by the end of the period. Okay, so that's the part of the cycle that we refer to as control. It incorporates a number of things. You first want to define what success means to you. That's when you set the benchmarks, right? And then you want to compile data on actual performance at periodic intervals, and then compare your actual performance to your budgeted benchmarks. Okay, comparing actuals to benchmarks will always give you a bunch of variances. Variance being any result, any outcome, any aspect of performance that is different in reality from what you were budgeting it or expecting it to be. Your variances can turn out to be either favorable or unfavorable, right? And you want to investigate what's driving your favorable and unfavorable variances and try to make sure you take corrective action to either suppress your unfavorable variances or try and reinforce the things that are giving you favorable variances. Okay? So a typical variance analysis proceeds on 2 levels, right? At the very beginning, and the reason we do the web company case from beginning to end is because it shows you the flow of steps that you need to use. And really you want to use the same flow of steps, the same method in every variance analysis question. You always start out with a level 1, and then from the level 1 you drill down to a level 2. Okay? So in the web company case, we started out preparing. What was the first thing that we prepared? Sorry? But what did we call it? The budget income statement, yes. The static budget, because that's it's made at a single point in time, and you can almost think about somebody laminated and hung it on the wall, so it never changes after that point, right? So we started out preparing the static budget. Then at the end, we moved forward to the end of the period. When actual results came in, we put actual results on the other side. We compared our static budget results to our actuals, and we calculated what we called an overall income variance, which can also be called a static budget variance. The static budget variance is the overall variance. It tells you your bottom line in reality is how much different, how much better or how much worse than your budgeted bottom line. Okay, and the bottom line refers to income, which is always the number that you want to have your eye on. Then when we investigated, when we thought about that static budget variance, we realized it was being driven by lots of different factors, 5 or 6 different factors in the West Company case. And so what we tried to do next was to try and separate out how much of that variance was coming from each of those factors, holding all of the other factors constant. So now we're trying to estimate some kind of causal effect. Each of those individual effects caused how much of that variance, holding constant the effect of everything else. Okay, because when you change lots of different dials at the same time, you don't know what's causing how much of your final effect. What we're trying to do is move only one dial at one time and keep all the other dials still. We found out from that decomposition, and here's how we did that decomposition. We inserted an intermediate step into the middle. We call that the flexible budget, or the level 1 flexible budget. The flexible budget answers the question, what would the static budget have looked like if you had known at that point how many units you were actually going to sell, what your actual volume was going to be. But keep in mind, no other piece of information about the future. Okay? So inserting the flexible budget allows us to decompose the static budget variance into a sales volume variance and a flexible budget variance. When you add those two up together, you should always get the original variance, because remember, these are just decompositions or disaggregations. Okay? So when you add up the sum of the parts, you always want to make sure you get the whole again. You should do that. You should get into the habit of doing that check every time. To make sure that your numbers are correct. So you will know at the end of a variance analysis question always whether you did it right or wrong. Okay, it's like a balance sheet. It's inherently self-balancing. Okay, so we figured this out. Okay, and then we left the sales volume variance alone. Why did we leave the sales volume variance alone and not try to disaggregate or decompose it further? Sorry? Because, no, actually it was unfavorable. But that's not the reason. Why did we leave the sales volume variance alone and not try to disaggregate it or decompose it further? Why did we only decompose the flexible budget variance? Why not the sales volume variance? Yeah. Yes, precisely, because the whole of this variance is coming from how many factors? Just one factor. So we have already broken it down. It is the lowest common sort of denominator in a sense. If this variance were the sum of 2 or 3 different effects, we would then try to break it down into how much was being driven by each of those effects. The flexible budget variance, on the other hand, as you saw, was still composed of an aggregation of very many different effects, each of which could move in different directions. And so that's why it's important to break that down. Okay? So I hope everyone understands that. So we broke down the flexible budget variance, and how we did this is relatively straightforward. There's no intermediate step or anything that has to be added. You simply break down the flexible budget variance line by line. You go line by line, you compare the flexible budget to the actuals, and you come up with each of these variances. So we came up with a selling price variance that was favorable. So here's what I'm going to do. I'm going to so this is favorable, green. And then we came up with a bunch of cost variances, all of which were unfavorable. Now, the interesting thing about the decomposition we did at this step was that the variances that we pulled out or that we unpacked from the decomposition turned out to be larger in magnitude than what they eventually netted out to, and you must understand that this is always a possibility. So never be fooled by variances that look small in amount, because when you disaggregate them, you might pull out 2 very large variances that are going in opposite directions and offsetting each other. Okay? If you did not disaggregate that variance at all, you would make the mistake of assuming that everything is going according to plan, whereas it really isn't. So there are different things that are going well and other things that are going badly, and they just offset each other out and make it seem as though your overall performance is not that much out of line with your benchmarks. You want to make sure you never make that mistake. That is a typical rookie mistake. Okay? And then that wraps up our level 1, actually. Okay, so everything until this point is level 1. Okay, then we moved on to a level 2, the very end of class. And level 2 variance analysis tries to work with your cost variances. Okay, now in the interest of full disclosure, you could do a level 2 variance analysis with your price as well, with everything. Every component that you get from a level 1 can be further broken down into level 2 variances, but we, for the purposes of this course, we're going to focus entirely on costs. Now, cost variances, as we learned last Tuesday, can arise broadly from two kinds of effects. There could be price effects going on, and there could be usage effects going on. Okay, and the reason that's the case is because all of your costs reflect the payment that you make for something that you're inputting into your production process, right? That's what gives rise to a cost. If you use some resource and pour it into production in some way or the other, that resource could be materials, it could be labor, it could be electricity, utilities, machinery time, expertise, any kind of resource. Now, all resources have a price that you pay per unit of that resource. So you have price per yard of material, a price per gallon of oil, price per pound of copper, and so on, right? And every product also calls for the usage of a certain specific quantity of that resource, right? So there is a price for every unit of that resource. There's a certain number of units that you plan to put into producing every piece of your output. And either of these two dimensions could vary from budget, and that's what gives you price variances and usage variances. Again, keep in mind you could have either or both kinds of variances at the same point in time. It doesn't have to be one or the other. An unfavorable price variance would arise if you ended up paying more than you expected to for every unit of your resource. Okay? An unfavorable usage variance arises if you end up paying more than you intended, if you ended up using more of that resource than you intended to make every piece of your finished product. So two very different effects. And so we worked with the cost variance, and we disentangled the cost variance, which worked out to be about 20,000 unfavorable in total, into a price and usage variance. And here again, we observed the same phenomenon going on that we observed when we disaggregated the flexible budget variance, which is when we disaggregated this variance, both of the variances that we pulled out, both of the effects that we pulled out were larger in magnitude than what they eventually netted out to. Okay, so what you have here is a not very large cost variance, okay, at the end of the day, but when you disaggregate the cost variance, you come up with a pretty large usage variance that's going in one direction, and a pretty large price variance that's going in another direction, and these two effects net each other off to give you a small cost variance. So you could theoretically have a zero cost variance, which will have a very large unfavorable usage variance and a very large favorable price variance, or the other way around. So always keep in mind that possibility. Okay? So this is what we did last class. Now the question is, how is this helpful? Okay? And how are we going to use this information that we have now from variance analysis to manage things better, or to exercise control, or to somehow try and get performance back in line with expectations. Okay? Now, interpreting variances is a learned art. Okay? It's not something that you will be able to do comfortably and smoothly right off the bat. You have to see very many different examples until you're able to start spotting certain telltale patterns that indicate that certain things are going on. But there's a few sort of cardinal rules that I like to discuss, which really help you in interpreting variances. So the first thing that this kind of disaggregated information does for you is it helps you to create a prioritized list sorted by importance of factors that need to be addressed, which you weren't able to do before you did the variance analysis. Okay, so if I were to ask you to pick out, okay, the troubling factors that need the most attention, or sort of the worrisome or the troubling issues that are largest in magnitude, which one would you pick out? Sorry? The direct labor cost. And why do you pick that out as number one? I'm sorry, who's talking? Yeah, okay. 38,000. Okay. That's right. So that's definitely a large item. What are the other large items? It's not a trick question. I'm sure you can sort numbers in order from largest to smallest. Yes. Yes. The sales volume effect is actually, it will not be largest, but it's definitely one of the largest, so it's unfavorable. Right? So that's another item that gets top priority. What else? That's right. The usage variance for direct materials, that's actually, in amounts, that's the single largest one. Right? What else? There's actually nothing else of the same order of magnitude. Right? All of the other effects that you isolated are relatively small. This one is pretty large, but it's a favorable variance. We'll get back to this. All of the other effects are relatively small. So 10,000 unfavorable, 9,000 unfavorable. They add up to a decent amount, of course, but individually as effects are relatively small. So really, if you wanted to make a prioritized list of action points or things that you want to investigate further, now you have a highly specific list of issues. You know, there was some issue with sales and marketing because you don't know why. You don't know why it ended up being unfavorable, but that's exactly what you want to find out. So variance analysis tells you the right questions to ask to the right sections of your organization. Okay? So it's obviously a big sales volume issue. The other big ticket issue is direct materials usage was very poor. Right? We used our material much less efficiently than we were supposed to, and that actually had a huge effect on our overall performance. As you can see, the total static budget variance is only 93,000, but the direct materials efficiency variance itself is 66,000. It's about 2/3 of that. Okay? And the other big issue was the direct labor cost variance. Of course, we didn't disaggregate that into a price and the usage variance, so we don't know exactly what's driving it, but the net result of both of those effects is still pretty large. Okay? So variance analysis points to you very specifically, here are the parts of the organization that you need to turn your attention to, and here are the questions that you need to ask. So now if you wanted to ask questions, you would go particularly to, when you went to the operations or when you went to your production department, you would ask, what is it that generated this unfavorable usage variance? Or why did we end up using so much more of the material? I think it was 2.22 yards as opposed to 2 yards, right? Why did we end up using an extra 11 or 12% of the material per jacket compared to what we were budgeted to use? So it gives you very, very highly specific questions to ask, and so it increases greatly the probability that you will be able to eventually put your finger on the problems that are really driving your unfavorable performance. Okay, so that's really the value in variance analysis. In order to be able to use this tool, every tool, of course, is only as good as the person who's using it. To be able to use it effectively, there are a few, I call them cardinal rules, that you want to keep in mind. The first one I've already emphasized many times: disaggregate as much as possible, because you can see from this, the more you disaggregate, the more information you get. A lot of the time, the disaggregated information that you get is surprising. It changes your beliefs. Okay? So disaggregate to the extent possible. Now, the second rule, the second cardinal rule that I want you to keep in mind is that you must investigate all variances. Okay? And what do I mean by that? I mean, you must investigate variances of both directions, unfavorable and favorable variances. Okay, all too often we make the mistake of thinking that only the unfavorable variances need to be looked into. Oh, the favorable variances are not a problem because that's going fine anyway. Okay, that turns out to be a mistake a lot of the time, and let's look at an example as to why. So I want you all to turn your attention to the materials cost variance. Okay, it's 44,000 favorable, 66,000 unfavorable. Now let's try to think of some of the factors that might have generated this favorable price variance. Okay, so again, visualize for yourselves what a favorable price variance means. It means, in this case, that the material was supposed to cost us $30 a yard, but instead we were able to buy it for, what is it, 29? 29 or 28, something like that, a couple of dollars less per year. Okay, so that is what is creating this favorable materials price variance. Now let's try to name some of the factors what might have enabled us to get the material for $2 less than we budgeted. Well, sort of a very obvious thing that could have happened is that the market price for that material could have been lower than what we expected it to be, maybe due to macroeconomic reasons or because there was an oversupply in the market and so on. Okay, so that's one obvious thing that could have happened. The overall market price dropped. Now, what are the implications of this with respect to evaluating the performance of your purchasing department? Is this positive news for the purchasing department? Is it negative news for the purchasing department, or is it neutral? Does it not have anything to do with them? The issue at hand is always try to keep in mind who's responsible for the action and who's controlling it. Okay? So is this something that was actively, is this a situation that is actively created by the people in your purchasing department? So it's neutral. So nobody's to be congratulated, nobody's to be blamed either. Okay? So that's the thing that you want to keep in mind. So a neutral event. Now suppose your purchasing manager negotiated some bulk purchase discounts. Okay, he researched suppliers very well, and he found some new suppliers, and he negotiated cleverly some kind of bulk purchase discount that enabled you to get the material for $2 lower than what you would otherwise have been able to buy the material for. Now, this is behavior that you want to what? Encourage or discourage? Encourage. This is clearly something that's positive. Okay? So that's an example of something that's neutral, doesn't have really any implications for you, wasn't really the fault or the responsibility of anyone within the organization. This is something that looks like behavior that you want to incentivize. Now suppose that favorable variance came out because the purchasing manager switched to a low quality material. It's also possible, right? He decided to go in for a slightly lower quality material in order to be able to get it at a lower price and to reduce the cost of production, and also maybe to exceed his department budget or whatever it is. Now, is that behavior that you want to encourage or discourage? We don't know. We don't know what the objectives of the organization are. If you're trying to create a brand impression of high quality and so on, that's behavior you want to discourage. Right? On the other hand, if you're a cost competitor and you don't really care that much about brand image, it may not matter. But let's suppose you're the first. That's definitely behavior that you would want to discourage. So the moral of this story is not so much the specific. I don't want you to try and memorize all of these factors, not at all. The moral of the story is you could have favorable variances coming out of behaviors that are not good, that you don't want to encourage. Okay, so don't celebrate as soon as you see a favorable variance, because it doesn't necessarily mean that somebody behaved in a way that you want to encourage them to behave. So favorable variances can come out of underlying reasons that are good and underlying reasons that are not preferred for you as an organization. So you want to investigate both types of variances, unfavorable as well as favorable. Okay, and that leads us to the last of the three rules, which is, it's a little bit at odds with what we did here. What we've done here is try to break out individually each of those effects, assuming that they were independent of all the other effects. But a lot of the time, variances can be linked. And what does that mean? Variances can be linked. What do you think it means? Sorry? Or that's one way of thinking about it, or that two or more variances have come out of the same underlying action. Somebody did something that caused a favorable variance in one part of the organization, and the same action might have also caused an unfavorable variance somewhere else. So variances can be linked in the sense that they both arise from the same underlying cause or effect. Okay, so let's go with that with the example that we just looked at, and let's suppose let's suppose we investigated the price variance and we realized that this is what gave rise to the favorable price variance. Maybe there's a guy switched to a lower quality material. Now, can you think of another variance that might be linked to the same underlying cause, same underlying action? Everyone understand the question? Suppose we investigated the price variance and we identified this to be the cause. Okay? This was the underlying action that was taken. Can you identify another variance up here on the board that might be related to the same cause? That might be the result of the same action. Selling price variance. Selling price variance favorable. So we sold the product for more than budgeted. How does that relate to the purchasing manager switching to a low quality material? This is a selling price variance. It means we sold the product at a higher price than we budgeted. How is that related to the purchasing manager switching to a low quality material? Think about it a little bit more, okay? Sometimes, I'm sorry? Okay, but this is part of the direct material cost variance, right? So in a way, your statement is tautological because you're saying, I mean, it's most certainly driven by the same thing because it's made up of this and something else. Okay. Perhaps. That's one, right? You can see here we ended up not being able to sell as much as we expected. Do you think that might have had something to do with the quality drop? You don't know for sure, but it definitely is a possibility, is a reasonable possibility that you want to investigate further. Okay? There's another item here that's even more directly linked to the same price variance. Does anyone see it? It's even more directly linked to this price variance. Yes, definitely the sales volume, but there's one more item. How about this? What does that usage variance indicate? Indicated that you ended up having to use more of the material to make each jacket than you budgeted. If you had ended up switching to a low quality material, perhaps you ended up having to throw out more of it. Or you weren't able to operate your machines at the same level of efficiency because the machines weren't running with the quality or the thread counts that they were expecting to be, that they were supposed to be running at. Okay? So, how do you spot these patterns? You have to look at many different scenarios and you have to see how the variances come out in each of those cases. That will get you primed over a period of time to start spotting these patterns. Okay? But often, tracing links between variances can really give you an insight into really important actions that are driving many different effects across your organization. There is another pair of variances that's linked, and I want to touch on that before we move on. Okay? There's another pair of variances that was linked. And these are two variances that are always linked, by the way. The selling price variance and the sales volume variance. Okay? Look at those two variances and interpret them for me. Tell me a story that might explain both of those variances. So pause. Yes. Naturally, right? And that's always the case. It comes out of fundamental economic theory. Demand curves are always downward sloping. So somebody here has obviously raised the price, right? Someone has raised the price. Why do people raise the price? They normally raise the price under the expectation that even if demand drops, it's not going to drop so much that your overall revenues end up going down. So that might be the underlying expectation. Unfortunately, that didn't work out, right? Because you got a favorable price bump of 50,000, but your demand dropped so much that at the end of the day, your overall revenues ended up going down, okay? So selling price variances and sales volume variances are always linked inherently, just by the fact that price affects demand, okay? And demand affects price and vice versa. And so over a period of time, you'll start being able to pick up more and more of these patterns. Keep in mind the three rules. Disaggregate as much as possible. Investigate the reasons for both favorable and unfavorable variances. that favorable variances do not always come out of behaviors that you want to encourage, right? And 3 variances can be linked, or they can travel in pairs, or one variance exists because the other one exists, right? So anytime you have linked variances, you want to pay particular attention, because it means there's some action that's very powerful in the effects, because it's creating many different effects across your organization. Okay? Now, the best way for you to get a sense of how to do this in practice is to actually practice. So I picked out many exercises from the chapter. So let's turn to the first one of those. Okay? They're on page 13. So take a minute and read. This is 717, okay, corner companies. Take a minute to read the requirements of the question. Okay. Corner companies budgeted prices for direct materials, direct manufacturing labor, and direct marketing labor per attaché case. This is a company that makes attaché cases. Okay, $40, $8, and $12 respectively. So what you're given here is information about budgeted costs under 3 cost categories: direct materials, direct manufacturing labor, and direct marketing labor. Now the president is given the following performance report, and he's pleased with the performance report. Okay. Now let's look at the performance report. There's 3 lines, 1 line for each of the cost items. The actual costs, $364,000, $78,000, and $110,000. And there's a static budget, your budgeted costs of $480 and $120. And then you have your variances. These variances are just simple comparisons between your static budget and your actual number. So these are just static budget variances, okay? And what do you notice about the direction of all 3 variances? They're all favorable. Keep in mind that the information here relates to what? Costs. So what does it mean that a cost variance is favorable? It means your actual costs were lower than your budgeted costs. And you can see that that's the case, right? All of your actual costs are lower than your budgeted costs. Now, let's take note about style. Your textbook actually lays out all of your variance analysis reports in the exact mirror image of the way I lay them out. Okay, so you'll always find the static budget to the right and the actual information to the left. Okay, I make a mistake every time, and I read it the opposite way, and I have to redo my calculations once over. So make sure you make sure that you're aware of the headings. Okay, so let's look at the additional information. Your actual output was 8,800 cases. Assume that all 3 direct cost items above are variable costs. And the question really is the president's pleasure justified? Okay? So a question is worded in this manner, but what it's really asking you to do is to comment on performance, right? You figure out independently whether performance this year was good, bad, or mediocre, and then you use that as a way to say if the president's pleasure was justified or not. Okay, so what you really have to do, and what you have to do in every variance analysis question really, is to come up with your own independent assessment of what actual performance was compared to budget. Okay, so before we jump into the numbers, into the specifics, does anyone have an intuition as to what it is that's happening here, as to what it is that's driving all of these favorable cost variances? Does anyone have an intuition? Can you speak up louder, please? Everyone else can hear you. Yeah. 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 That certainly is the cost driver. The question is, what do you think is driving the favorable variances? Just by eyeballing the numbers, can you diagnose why all the variances are favorable? When you put the answer up on the board, it's going to be very obvious. Okay, so let's start putting some numbers into it, and and I'm sure you all will see it in a couple of minutes. Okay? So every variance analysis question we are going to tackle in the exact same way. We are going to lay out the static budget. We're going to lay out the actuals. We're going to look at the static budget variances. Here they've already been done for us. And then we're going to go ahead and we're going to do a level 1 variance analysis. We're going to put in a flexible budget. We're going to calculate all of those variances. And then we're going to step back and see what comes out. Okay? So every variance analysis question, regardless of how it's phrased, you address in the same way. Okay? So this is called a static budget. This is actual. Okay? 3 cost categories: direct materials, direct manufacturing labor, and direct marketing labor. Okay, so direct materials, 400,000. Direct manufacturing labor, 80,000. Direct marketing labor, 120,000. Now, do you remember something that I told you when we did the web company example? Put down not only the final numbers, but also break them down into the components, into the elements. What multiplied into what is giving you these numbers? It will help you greatly in your variance analysis. Okay? So let's break this cost down into a volume and a rate. So someone break it down for us. The total cost of 400,000 came from what? That's right. So can you put numbers to them, please? Look at the information that's given on top. This is the budget, remember. Take your time. That's right. So the budgeted material cost per unit is 40. Right? So now the rest becomes obvious. So you must have budgeted to make 10,000 pieces. Right? 10,000 units. Everyone is clear about this step? Right? This is the information that you were given, and you know the total budgeted costs were there, so you must have budgeted to make 10,000. You infer that. So you use a similar logic to fill in all of the others. Your direct labor costs, 8 per unit. Okay? So again, you know that you expected to make 10,000. And finally, 10,000 times 12 a unit. So always decompose into the lowest common denominators, okay, into the elements. It will help you really a lot in doing your variance analysis. So now we're going to lay out the actuals. So the actual costs are 364,000, 78,000, and 110,000. Okay? Now, we can do the same thing here. We can break the actual costs down also into a volume times a rate. Now, here what you know is the actual volume, right? You know that actual volume was 8,800. So you use that to infer what the materials must have cost you per unit. Okay, 364,000 divided by 88. So what does that work out to? 41.6? 41.36. Okay, so 41.36 per unit. Similarly, here, 8,800 units times 78,000 divided by 8,800, which is 8.86 per unit. And then finally, 8,800 units times 12.5 per unit. Everyone is clear about every single one of these steps? Is there a question? Okay, so now can you diagnose why all of those static budget variances were favorable? As soon as you put the components down, it gives you a vastly greater understanding of exactly what's happening, which of the dials are being turned and which of the buttons are being pushed. So can anyone diagnose the reason why all of the static budget variances are favorable? That's right. So there was less produced, so naturally you would expect all of your static budget cost amounts in total to be lower than your actual cost amounts to be lower than your static budget cost amounts. Now, is that reason to conclude that performance was good? Not necessarily, right? In fact, your performance has been poor on both dimensions. Not only have you produced less than you expected to, but for every single one of those 8800 that you did produce, you were slightly less cost efficient than you were supposed to be, because on average per unit it cost you more. It shouldn't have cost you 41.36 but only 40 and so on. Does everyone see this now? So the minute you break down, you can see now the power of decomposing into components. The minute you break it down into the components, you're able to see at a glance, okay, what are the effects going on, which ones are pushing in a favorable direction and which ones are pushing in an unfavorable direction. Okay. Now a quick proviso to the above. You could have a situation where you produced fewer units and your total costs ended up being larger. It's not impossible. However, what that means is that your costs per unit were extraordinarily larger than what you expected it to be. Okay? So in most circumstances, if you produce less, your costs will turn out to be less unless something is exceptionally wrong with your production process or with how efficiently you're producing. Okay? So now, really, in order to push this a little bit further, what you want to ask yourself is, what is a meaningful benchmark for you to compare these actual costs to? Clearly, you're all agreeing with me that this is not a meaningful benchmark, right? Because this is cost for 10,000 jackets, whereas you only made 8,800 jackets. So what is a meaningful benchmark for us to compare these actual costs to? Correct. That is right. You want to ask the question, how much should it have cost us to produce 8,800 units, right? But that is the same thing as creating a flexible budget. Okay? So we're going to put a flexible budget in here. Okay, and remember, a flexible budget is going to answer the question, what is it supposed to have cost you in total to make 8,800 units? Or in other words, if you had known at this point in time that you were going to make 8,800 units, what would you have forecasted your total costs to be? So actual volume times all your budgeted costs. Right? And so let's figure out what this gives us. Okay, for 352,000 here. 70,400 here, and 105,600 here. Everyone is happy with the flexible budget, understands where it came from, why we put it in there. Okay? Now that you have the flexible budget, what can you do? You can calculate two sets of variances. You can calculate sales volume variances, where you compare the static budget to the flexible budget. Clearly, all your sales volume variances are going to be favorable or unfavorable? Unfavorable, because your actual sales volume is lower than budgeted sales volume. I'm sorry, these are cost items. I'm sorry, they're going to be favorable, right? Because your actual costs are lower than budgeted costs. But what is the number that you really want to focus on? You want to focus on the flexible budget variances, because they really tell you how efficiently did you produce the 8,800 units that you ultimately ended up being able to sell. So go ahead and calculate all of these variances. So your direct materials cost variance is 364 minus 352 is 12,000 unfavorable. Right, because direct materials cost you 12,000 more than they should have. Your direct manufacturing labor cost variance is 7,600, again unfavorable, because direct manufacturing labor cost you 7,400 more than it should have. And this is also 4,400 unfavorable. Okay, so your sales volume variances, these are your flexible budget variances. And if you like, you can put in your sales volume variances also. Sales volume variance line by line, which is 48,000 favorable. 9,600 favorable. $14,400 favorable. So what you have here really is, you can notice a very striking pattern across the variances. You have a bunch of sales volume variances that are all very highly favorable, right? Because your actual sales volume was lower than budgeted sales volume. You have those items being offset by a bunch of cost variances that are all unfavorable. So really, if you want to summarize both of these phenomena in two lines, you would say, well, actual performance was from a sales perspective was lower than expected, right? And so that generated lots of favorable looking sales volume variances, but actually our production performance was worse than expected, because for the 8,800 units that we made and sold, we ended up incurring costs significantly higher than what we should have. So our performance has actually been poor both on sales dimension as well as in terms of efficiency of production. Okay? So you understand, I hope this example gives you an idea of the power of disaggregating variances. If you had not disaggregated variances by putting a flexible budget in between, what would you have been left with? You would have been left entirely with these favorable variances that were given to you in the question. You look at those variances, they're favorable, yes, you performed well. That's a completely, you understand, that's a completely inaccurate and artificial view of events. Okay? So don't be thrown off by the way in which a question is worded. Variance analysis questions can be worded in many different ways, but there's really only one way to answer every question, which is to set up the static budget, set up the actuals, put in the flexible budget, disaggregate all of the variances that you can with the information that you have, and then step back and try to interpret the variances and see what they tell you about performance. Okay? Sometimes you will only be given information to do level 1. That's the case, you do level 1 and you stop there. Sometimes you'll be given information to go all the way down to level 2. Take it until that point if you can. Sometimes you will be given only information to do a level 2. So you just be given all the level 1 numbers now to do a level 2. So first figure out what level of analysis the question is asking you to do, and then just proceed with that. Look at all the numbers and then step back and try to compose your thoughts and come up with an answer. Any questions? No, this what we do here is it's quite colloquially referred to as a level 1 variance analysis. Yes, this is entirely level 1. Everything until this point is a level 1 variance analysis. Everything below that point is a level 2. I don't care what you call it as long as you understand the right variances to answer each question. Okay? Sorry? No. This decomposition is a level 2 decomposition. Yes. This decomposition is a level 2. Everything up to that point is level 1 decomposition. Okay. Okay, shall we move on to the second question? Okay, and I want to make you do this a little bit independently. Okay, so 720. So this is Marin Incorporated. They produce the basic fillings used in many popular desserts and treats. Okay. Madam carries over no inventory from one period to the next. So there's no ending inventory, there's no opening inventory, very simple situation. Here are the ice cream product group's results for June 2007. And again, the static budget is on the right and the actuals are on the left, okay? So just keep that sorted out. Let's look at the static budget first. We were supposed to produce 500,000 pounds of ice cream, okay? And those pounds were supposed to give you, budgeted to give you total revenues of 3.25 million at a variable manufacturing cost of 1.75 million, giving you a budgeted contribution margin of 1.5 million. Now, let's look at actual results. Actual volume was a little bit higher than budgeted, 525,000 pounds of ice cream sold. So clearly, you expect total revenues to be, you might expect them to be greater. That would not be unreasonable, and they are greater, 3.36 million. However, your variable costs are also greater. Again, you would expect them to be, right, because they're all variable costs, so the more you produce, the larger the costs are in total. So your overall contribution margin, unfortunately, is only 1.47 million. So that's about 30,000 lower than budgeted. So unfortunately, even though your revenues rose, your costs rose more than the revenue. So that tells you. Now, Ted Levine, the business manager for ice cream products, is pleased that more pounds of ice cream were sold compared to budgeted, right? And he's also pleased that revenues were up. Unfortunately, variable costs went up too. The bottom line is that contribution margin declined by 30,000, which is less than 1% of the budgeted revenues of 3.25 million. So he's finding a way to justify, probably to his CEO, that the overall 30,000 unfavorable variance is not a big deal because it's small in amount compared to revenues. It's only about 1% of revenue, so it's hardly a blip. That's the argument. Overall, Ted feels that the business is doing fine. Okay? So again, what you have to do is you have to come up with your own independent diagnosis of how the business is doing. Okay? So the information that's given to you here is static budget and actual. So what level of variance analysis are you at currently? You need to do a level 1 variance analysis. Okay? So I'm going to lay out the basic structure, and I want you all to independently put in some of the numbers just to get the hang of doing it yourself. Okay? So we are going to proceed with the level 1 variance analysis for Marin. So we start off with the static budget here. And we put our actuals here. Okay? Fortunately, the numbers are simple. There are only 2 lines. So I'm going to put the volume up here on top. Okay? So this is 500,000 pounds budgeted volume. Actual volume is 500 and okay. Now revenues and variable costs. Now budgeted revenues 3.25 million and budgeted variable costs 1.75 million, giving you contribution margin 1.5 million. Now, what should you do before you move on? What should you do with these numbers before you move on? Break them down. Break them down, put the components down. Get into the habit of doing that, okay? You will be lost with variance analysis if you don't break them down. Because there's just too many things going on inside these numbers for you to be able to tell. Okay? So break these numbers down. How do I go about breaking the revenue number down? We'll have one component right up here on top. This is volume. This is how many pounds of ice cream we sold, right? So 500,000 pounds must have been sold at a selling price per pound of 3.25 million divided by 500,000. Okay? What is that? Are you sure? I think 6.5. Okay? 6.5 per pound. You want to do the same thing with variable cost. 500,000 pounds were budgeted to be produced at a variable cost of 1.75 divided by 500,000, which is 3.5 a pound. Okay? Now, let's move on to the actual. 3.36 million and 1.39 million. Okay? Do the same thing with the actual. Do the same thing with the actual. 525,000 pounds was sold at an actual selling price of, the actual selling price? You don't know? This is total revenues. This is how many pounds of ice cream was sold to make the revenue. So you divide this by this. Okay? 6.4 per pound. Do the same thing here. So 525,000 pounds were made at an average cost per pound of 3.6 per pound. So as soon as you put these components down, you can see all of the effects that are going on now. Right? Your sales volume was higher than expected. So it's going to give you some overall favorable revenue variances, unfavorable cost variances for sales volume. How about your rates? What are the rates telling you? The rates are telling you that every pound was supposed to be sold at 6.5, but has actually only been sold at 6.4. Now, why does that kind of make sense in this situation? So, you notice the two will always, most of the time, are going to end up going together. Okay, so somebody probably dropped the price under the expectation of increasing sales revenues, and was the strategy effective? At least looking at revenues, you'd say it was, because overall revenues went up. So demand obviously didn't drop by so much that your overall revenues went up. So that's one thing that happened. How about production efficiency? Sorry? That is right. So production efficiency was not as it was hoped, right? It was supposed to turn out ice cream at $3.50 a cost per pound. Fortunately, the cost inched up to 3.6. Okay? So how do you separate out all these effects? To separate out all these effects, you want to put in a flexible budget. I want you guys to go ahead and do the flexible budget on your own. Take 2 or 3 minutes. Go ahead and do the flexible budget on your own. If you have a question, you can ask. Feel free to ask. Is anyone ready to give me the flexible budget amounts for revenues? Flexible budget amounts for revenues. $3,412,500, and that becomes by That's right. So this number is really telling you, well, if you sold 525,000 pounds by stream, how much money should you have made in revenue, right? And the next line is going to answer the question, how much should it have cost you to make 525,000? So that's going to be, again, 525,000 pounds times your budgeted cost of 3.5 per pound. And what does that work out to? 500. 1,837,500. So your flexible budget income is 1,575. Thank you. 1,575,000. So interpret this number for a second. What this is telling you is, assuming everything else had gone according to plan, if you had sold 525,000 pounds, this is how much money you should have made. Okay? So really, this is the appropriate benchmark against which you compare your actual performance. Because now we restated what our budget would have looked like had we actually sold 575,000 pounds. So let's first calculate this variance. This is what we call, as you all know, the sales volume variance. And what is the sales volume variance in this case? The sales volume variance in this case is $75,000 favorable, right? Because our flexible budget income is larger than our static budget income. So sales volume variance is favorable. However, let's now look at our flexible budget variance. How about our flexible budget variance? What is the flexible budget variance? What is it? Amount and direction, see? $105,000 unfavorable, right? 105,000 unfavorable. Why is it unfavorable? Because at 525,000 pounds, you should have made $1,575,000 in money in profit, but you only made 1,470,000. Okay? So when you try to interpret these numbers, very interesting interpretation that comes out. Okay? Somebody has obviously made a push to increase what? Sales. Right? You can clearly see that because it dropped the price. Right? And to some extent it seems to have worked because your overall revenues went up. Unfortunately, something else also happened. What is that something else? Your costs went up disproportionately. Your costs went up by more than your revenues, right? As a result of which, your total flexible budget variance is very negative. It's more negative than the sales volume variance is positive, and that's what's giving you this 30,000. Okay? Now, can you visualize some of the reasons why your costs might have gone up? Knowing what you know from here. By the way, we can break down some more variances. This is your selling price variance, right? This is your cost variance. The selling price variance is 52,500 unfavorable, and your cost variance is 52,500 unfavorable. So we can break down some more variances here. Okay? Now, why do you think the cost variance is unfavorable? Why do you think costs went up? Knowing what you know from here. Take a guess. I'm asking you to put the two facts together and Take a guess. An informed guess. What kind of production was this extra 25,000? Do you think it was scheduled production or unscheduled production? Unscheduled production, clearly, because you weren't scheduling to make those extra 25,000 pounds at the beginning of the period, right? Because it's not in your static budget. But you suddenly ended up having to make it over the course of the period. Now, do you think unscheduled production is more expensive or less expensive than regularly scheduled production? Why? Because you need to put together your factors of production at short notice. Anytime you need something at short notice, unit for unit, it ends up being more expensive than if you had gone out on an open market and negotiated with as much bargaining power as the other party, right? Take a simple example, labor. You might not have ended up hiring enough employees because you only budgeted staff for 500,000 units of production. So what do you need to do at the last minute? You need to get your employees to work. To work what? Overtime, probably. And overtime, typically, hour by hour is more expensive than regular time. Take materials. You need to go out there and you need to get fresh supplies of materials at short notice. Whenever you need to do something at short notice, that puts you at a bargaining disadvantage relative to the other party. You can always assume that we're operating in efficient markets, that somebody else is going to try and take advantage of the situation that you're in. Okay? So here what you have is a clear example. Again, these are all sort of informed guesses that we're making about what could have happened. You have a clear example here of not enough coordination between what happened on the marketing side and what happened on the production side. So unfortunately, your overall performance ended up being worse than expected. Okay? We're done with budgeting. Okay? We're going to do one more example on Monday and then we start decision making. Have a good weekend.